Have you just sold your house? Congrats! But before you blow all that cash, there's a sneaky tax called capital gains that might take a bite. This video cuts to the chase. How capital gains taxes work and how to keep more money in your pocket. Let's take a step back and talk about what capital gains taxes exactly are and how they can impact you as a homeowner. You may be subject to taxes on your earned profit when you sell your home for more than you paid. First things first, let's talk numbers. In 2023, many homeowners across the U.S. made a profit selling their properties despite a slump in home sales. According to data from Adam, the median profit for selling a single-family home was around $121,000. That's down slightly from the previous year, but it's still a significant amount of money. Here's where things can get tricky. Sometimes, the profits from selling your home can exceed the limits set by the IRS for tax-free gains, and things can get a little hairy. But fear not, because the tax laws were written to encourage homeownership, and many sellers qualify for a tax break. For example, if you're a single homeowner, you can shield up to $250,000 of your home sales profit from capital gains taxes. And if you're married and filing jointly, that exclusion doubles to a whopping $500,000. It's a pretty sweet deal. But of course, there are some rules and eligibility requirements to qualify for those exclusions. One of the critical requirements is the ownership test, which says you must have owned the home for at least 2 of the past 5 years before selling it. And if you're married and filing jointly, only one spouse needs to meet that requirement. Then there's the residence test, which requires the home to be your primary residence for at least 24 months out of the 5 years before you sell it. But wait, there's more! You might still be eligible for a partial exclusion if you sold your home due to unavoidable circumstances, like a job change, health issues, or unforeseeable events. However, there's a catch. You generally can't get the tax break if you've already claimed the exclusion for selling another home within 2 years of your closing date. Now, let's talk about how you can lower your tax bill if your home sale profits exceed those IRS exclusions. One way to do it is by increasing your home's basis, or original purchase price. You can bump up your basis by adding the cost of specific improvements you've made to the property that have prolonged its useful life, according to the IRS. Consider home additions, updated systems, landscaping, or new appliances. But here's the kicker. Repairs and maintenance generally don't count towards increasing your basis. So keep detailed records of any improvements you make to your home, because you'll need them to prove your case if you ever get audited. Regarding audits, here's a pro tip. Complete the paperwork. Sure, the IRS gets a copy of Form 1099-S after you sell your home, but you'll need documentation to prove any changes to your home's basis. Failing to keep records of your home improvements throughout your ownership is a common mistake that could cost you big time come tax season. Finally, keep those wallets happy and those tax bills low. Remember to subscribe to our channel for more money-saving tips.